Welcome to the ALX Show, your premier source for DFW real estate data and insights. Let's get to it. Hello, Josh and Patrick. Welcome back to another episode of the ALX Show. Today, we are going to be talking about deficit spending, what's happening in the bond market, and if there's time, we'll start talking about some renovation and home flipping options and financing that folks are exploring. So first up, there is an article that was published this week in the Wall Street Journal, and it's called Simple Economic Explanations Keep Breaking Down. Here's why. And so they go into three different narratives that folks use to basically explain what's happening in the economy and why maybe why that narrative or that story is not working correctly. And so the first story is government spending. So as we know, we're heading into the election season, the final stages of the election. We're recording today. It's October 22nd. So we're about 2 weeks out from the election. And a headline story on the campaign trail is deficit spending, or government spending. And the government is spending a lot more money than really ever before. And so I just want to read really quickly a little section from the Wall Street Journal where it said, it was talking about how folks were warning that as Biden's stimulus package that went through a couple of years ago went through the economy, it was going to create inflation. And sure enough, that turned out to be the case. And yet, this is where the Wall Street Journal picks up, and yet the government kept on spending into a hot economy. Over the past 2 years, well after the pandemic stimulus, the federal deficit has been larger as a share of the economy than any time since World War II, aside from the deep recession after Lehman Brothers collapse in 2008 and the pandemic itself. The economy also kept growing relentlessly, expanding faster than the Federal Reserve's estimate of the long-run sustainable level in all but one quarter. So inflation should have kept rising, right? Well, no. And that's where it kind of goes into some of that. So I wanted to pick up that story with you guys. And Josh, you were mentioning before we started recording that deficit spending is such a major concern that it is affecting the bond market and yields on bonds, which is therefore affecting the real estate market and financing and things like that. So can you talk a little bit about what you're seeing in the bond market and how that's affecting you guys at ALX?
Yeah, so here recently, the 10-year Treasury has gone up to 4.2%, the yield on it. And I think as recently as a month ago, it was down to 3.75. I mean, so pretty dramatic jump, 50 basis point jump in a short period of time. And that's not unusual for the last few years. We've seen, outsized moves, more regularly than we would like. And you spoke about the deficit spending, and like you said, we talked about this before. It's a supply and demand issue. The government issues more debt out there, then that's going to increase the yields on that debt because the prices are going to come in. So how does that affect us? It makes our borrowing more expensive because everything we're looking at is tied to the 10-year Treasury. The 10-year Treasury yield moves out, then our borrowing expenses move out with it. And that's true for mortgage rates too, as we've spoken about before. So like the mortgage rate today is at 6.85. Well, that's because where it was in the low sixes, a month ago. Well, that's because it's tracking with that 10-year. As the 10-year moves up, so do those mortgage rates.
Well, and to put to bring it back to the article that you started with about the narrative kind of being unsure, the bond market narrative, the investors in the bond market have been unsure of the narrative too for a long time. So we talk a lot about the long end of the curve, the 10-year, because that is the benchmark for so much. The short end of the curve, which we all kind of anticipated the long end would move up over time as we started to cut rates, because the yield curve would, uninvert and normalize. But what's also happening is the short end is still increasing in yield too, which is a little bit of surprise, but just reflecting the idea that investors in the bond market are expecting less rate cuts than they were initially too. And to jive with the article, they've been incorrect a lot through this last 2 years of hikes and now cuts. And so there's been a lot of correction in the 2 year, which think of the 2 year kind of as a proxy of the future Fed funds direction. And so it's 3.5 a month ago, and now you're over 4 again. And so just because their sentiment is now shifting toward, hey, we might not need to cut as much as we thought we were going to have to do, doesn't mean that can't change again too, because like that article said, each data point that comes in kind of confuses the narrative, and it's never really quite as simple as we expect it to be.
And we're jumping from what was a recession concern starts to go away when you've got a strong jobs report, to now you get concerned about fiscal policy. Well, are we borrowing too much? Are we issuing too much debt? So like Patrick's saying, like we're talking about, it's going back and forth from these different concerns or opinions of what's really happening when no one really knows. Like the article said, I mean, the economy's so big that it's hard to really nail down any underlying trend that really allows you to see what's happening or what's going to happen. But that's just where the confusing times. We had the supply chain disruptions, we have all the government spending, we've got really confusing macro level economic reports that like Patterson, we could get one out here next week that could change the narrative again. If we have a soft jobs number, then are people going to go right back into, well, are we staring down a recession? And then all of a sudden the government spending doesn't pose as much of a concern. So there's just a lot out there. The election being around the corner too, and what that's going to bring as far as new policy into 2025. Anytime, like we talked about, anytime there's uncertainty or volatility, people typically are going to take a step back. You hear all the time that that's where people really make money, but it's also where people can that's if you bet right. But there's also the chance that you could bet wrong. So, and I think most people are a little bit more risk adverse than those out there really charging forward, and that's why we're seeing just generally kind of people in a wait and see mode, trying to feel this out.
Yeah, I think people are, to your point, like are afraid to bet wrong, whether it's buying a house or renovating a house, which we might get to in a little bit, or making an investment, so investing in a property or some other kind of investment, stocks, bonds, whatever it might be. And I have a question on that, but before I get there, the second part of the article was on monetary policy, that this is a narrative that's been confusing, and this is kind of the point that Patrick was making earlier. And I just want to read a little bit of that, where it was saying monetary policy hasn't been particularly useful for forecasting either. As one Fed policymaker put it, if you had asked any reputable economist what would happen to the economy if you jacked up rates from 0 to above 5% in a little over a year, they would have predicted a deep recession. Instead, everything was hunky-dory. And so it kind of explains some of the models that monetarists were using to talk about the M2 money supply and how that model would have thought that trouble was ahead. And so what it says here, to round out this part, it says, but while the model appeared to work, the inflation that followed was extremely high. It then predicted deep trouble ahead, perhaps even deflation and surely a recession, as M2 shrank year over year for the first time in modern history. So far, that has been wrong. So my question is, what do we do? I mean, what do you guys do? I mean, you're seeing these stories develop, you're watching the data come out, you're seeing all this like kind of conflicting reports, or there's just so much going on. What do you guys recommend? I mean, how do we go forward from here? How do we make sense of some of these confusing data points here?
I mean, it totally depends on your situation, right? Are you asking from the perspective of a homeowner? Then my advice would be, if you don't have to buy or sell right now, now if you've got cash, it really doesn't matter. You can buy or sell. Now you're kind of playing with where you think values are going to go. But if you're relying on financing, I would say that you're probably the best thing to do right now is just wait and see, because I think a lot of these things will work themselves out over the next several months, and we'll have an idea of kind of where that fiscal policy is headed and in what direction, depending on who's in control. But if you don't have to go out and buy a new house today, unless you've got cash and you find something that you love, and you think that values are going to go up as mortgage rates do come down, because the Fed is still, although there may be backing off like those outsized rate cuts, those 50 basis point cuts, they're still saying they think that it's appropriate to continue to cut rates maybe 25 basis points at a time. So in doing that, as long as inflation continues its downward trend, then rates should still come in. So I would say, yeah, maybe wait until the spring of 2025. You do run the risk of home values going up, because if a lot of people have the same idea, there could be a lot of demand. Hopefully that's offset a little bit by more people putting their home on the market, so supply goes up. If you're an investor, it's the same deal. It depends on your capital stack. I mean, how reliant are you on debt? If you've got a lot of cash that you can deploy, this might still be a great opportunity through the uncertainty to go get a good deal. But if, like most investment groups, you leverage, a certain chunk of your deal, then you're going to want to really be careful about moving forward. I think especially if in the span of 30 days, you can have a, 40, 50 point basis point move, then, that can really change the economics of your deal while you have it under contract. So I think it totally depends on your situation. But ultimately, where we land is we think it's a great time, a great time just to get ready. So we think 2025 is going to be a much better year, a much more active year. So we think there's still great opportunity depending on where you live here in DFW. We think there's going to be great opportunity in the residential market, both in single family and in multifamily. So we think you just kind of, you patiently endure. And then we think that the doors will open here sooner than later. And when they do, you just need to be ready to walk through them.
Yeah, to piggyback, I think the two important things to continually remind yourself of, and I do this all the time, is first, it's really fun to kind of have your own idea of where things are going and see if you're correct and all that. But you kind of have to throw that out and just kind of let the data happen to you and just navigate as it comes, instead of sticking to a short term, hey, I think this is what's going to happen, I'm going to make decisions based on that. Because if you're wrong, then you're going to be in a tough spot, which is related to the second point, which is what Josh is talking about, which is have a strategy that's a long-term game. When we say we're really high on residential real estate here in DFW or in Texas broadly, that's not a 1 year time horizon. That's over the next 5 years. We're looking at structural things that we see, namely housing shortages and conditions that are going to become more favorable. They might not happen as quickly as we thought, 6 months versus 8 months or 10 or 12. But we know over the long term, conditions are going to become more favorable. There's structural shortage that has to be addressed. It can only be addressed through more investment and more activity. And so when you take the long-term perspective, you can, put together a plan that makes more sense.
Okay, that's really helpful. Basically, wait, watch the data, and make smart decisions.
If your next move is dependent on financing, then yes, I think wait while you can. There's always great opportunities though, and there's different circumstances around each deal. So you certainly don't want to back off a good thing if it's presented to you. But just generally, as far as a strategy, as painful as it is, I think just continuing, like I said, to endure, and then expecting good things to happen and expecting the market to open up. But then, like Patrick said, having a strategy to know what to do if it doesn't move like you think it will, and be willing to be flexible and don't be so rigid in having to do one thing. That's something that we've learned. I think as long as you are really operating within your gifts and your experience, and you've got a team that's doing that as well, and you can apply those core competencies and those abilities to a number of things, but you stay true to those, and then you see where you can best activate them. And for us, that's in underwriting and finance, this private lending or providing equity. That's where we feel like we best fit. So being able to position that to be successful regardless of where the market is, but just planning. If it goes this way, this is how we can use this. If it goes the other way, we can use it, this way. So just being flexible, knowing what you're good at, and not reacting, but being able to see where to best use.
Yeah.
What you're best at.
Yeah. Yeah, Patrick, you on your point, you had talked about waiting and seeing the data, and not all data is publicly available or is easy to find. A lot of the data that we talk about is, I mean, it's all a lot of government data or from institutions that are publishing this kind of stuff every month or every quarter. But one of the things that I want to do with this podcast is to share insights that you guys are finding on the ground that is not so easy to find, and it comes from people that are living and breathing this every day like y'all, and the experts and the network and the resources that you guys have at your disposal. And so you've mentioned some anecdotes that you have that you've heard from others in your network that have been useful in kind of providing a little bit more clarity or more perspective on how to view things right now. So could you share a little bit about what you've heard this last week?
Yes. Okay, I'll share 2 anecdotes, but before I do that too, on your point about data, if I could nerd out real quick and just
please, yeah, that's
data that's a little bit
do.
harder to come by that I think might be helpful in what we're talking about. So the deficit spending that we talked about is, potentially looming, and we are just kind of all waiting to see when that starts to show up in the numbers. And when does issuing all of this debt kind of start to bite us? And so one way that I've become convinced that we'll be able to kind of see that before it really starts to happen in a painful way is through watching the Treasury auctions. And so that can get real complicated, and I won't go into a ton of detail about it. But the idea is that you will be able to see when investors are no longer wanting to pay the yields that are being asked, or demand starts to really soften because there's so much supply coming to market. And just like everything else out there, I looked at the last month or so of auctions, and it's kind of a mixed bag. So we're expecting it to kind of all, general consensus is like it's going to turn into real negative sentiment out there, but it's still a mixed bag. We actually still have really strong demand for our Treasury issuances right now. When I say that, that means typically foreign buyers are the biggest investors in U.S. Treasuries. Almost all of the auctions have really, really strong, like above historical levels of demand of foreign investors, which is always a great sign of the appetite is still there. Counter to that, though, in the complicated narratives that we've got, there's still investors are starting to request a little bit higher yield than what's initially being thrown out there. So we call that a tail in an auction, and just means that the yield that is finally decided at the end of the auction is a little bit higher than where they kind of pre-thought that it was going to be. And basically means that, hey, we're interested in buying this bond from the United States government, but we've got to accept a little bit higher yield to do so. And that's always the risk with as much as we're issuing, is that that's just going to continue to creep up a little bit more and more. So anyway, that's something that we track that's not, always in the headlines. It's kind of a nerdy thing, but I think that that's going to show some sign of future pain, if there is going to be any, with the amount of money that we're issuing. So
I feel like we could do a whole episode on that, because I have no idea what you just said, but it sounds really great. No, I'm just kidding. But no, it's very sophisticated to look at some of that stuff, and I really don't know much about how to go about doing it. So yeah, I would love love 20 minutes.
What Patrick's talking about
tell me about all that.
He's talking about the actual auction, like the primary bond market, and then what we're looking at when we look at borrowing yields, we're talking about the secondary market. What are those bonds trading for after they've been initially sold? So it is very interesting to see how the demand won, and also what the initial yields are, what the initial pricing is.
Interesting. Okay, I love that. Yeah, Patrick, put a pin in that. I would love to talk to you about that another time. That's cool.
Yeah, sure. Okay, so on to more relatable things that people understand. Anecdotes that we visited with a couple brokers last week that we've done a lot of business with, and they're great guys and really good at what they do, and just got a lot of feedback on how buyers, and this is really specific to the multifamily world, how their sentiment has shifted over the last few months, and just got some encouraging feedback that there's starting to be a lot more inquiries from people who are ready to jump back in. One, so more buyers kind of poking around. Two, there had been for maybe about a year or so this idea that if you were going to buy, it had to be like you were going to get a steal of a deal. You wanted to find something that was really distressed, that you could get at a really good price, so that you'd be able to line up your home run. And that idea is kind of starting to fade. And people are coming in back to just normal fundamentals and wanting to acquire things that make sense and still, hit a good price so that you can, model out something nice. But it's not necessarily the same looking for the deep distress kind of sentiment that had been here for the last year or so. So that's a big shift. And then I guess the last thing is there's been a settling, I think, in cap rates. And it's always been tough to tell where cap rates are because so few deals have actually, traded. And there's been, but the feedback that we've gotten is that there's started to be some footing around, specifically around the Class A assets that were probably got to up to like a 5% or so cap rate. And I think people were expecting that to continue to rise. And that never really did. And they kind of settled there. And then over the last month, there's been a couple properties here in DFW that have traded that are Class A in the upper 4 cap range, so even a little bit less than where they had been. And so that's going to start to filter through the market, through the Bs and then to the Cs as, the months go on. So overall, I think that was some good news and feedback for, the direction of where we're headed going into 25.
Well, rent growth is coming back. So there's part of it too is that the fundamentals are kind of coming back around, what you say. So I think the wait for that, great deal that a lot of people in the acquisition mode were hoping for, kind of realized that maybe they found it, but a lot of people didn't, and realizing that it's not just going to be this rush of properties onto the market that are all distressed and people are going to buy in at an amazing position. So I think that mindset is starting to go away if it hasn't completely gone away. Probably when they first started cutting rates is when people realized, okay, we're probably bottoming out here value wise. So now is the time maybe to get back in. And because we're seeing rent growth start to come back to where it was basically flat, if not negative for the last 18 months to 2 years. It's starting to show signs of increasing again. We're getting some relief on property taxes compared to previous years, and also on insurance is a little bit more predictable, I'd say, don't you think, than from what we've seen, certainly. Yeah. So there was some big headwinds in the multifamily space, interest rates, taxes, and insurance that are all starting to show signs of relief. And in doing that, that increases NOI, and also it kind of stabilizes like the cap rate levels too, while you're increasing NOI. So if you're an owner, then you're starting to see a light at the end here. Is okay, we're through the worst of it, and now we're moving back into a better position, and you have better options whether you want to refi properties or sell them. You should have better terms, certainly, and then hopefully, like Patrick's mentioning, you have a lot of demand if you do want to take something to market.
That's great. That's all very good news. I'm really glad to hear that. I sense that just in my little anecdotal world, like in my neighborhood, I've noticed a lot more for sale signs or for rent signs than I've seen even before, just a few months ago. So maybe that is true, that a lot of this sentiment, if you call it that, and as everybody knows, sentiment is very, very powerful on markets in a lot of different ways. But as people are feeling a bit better about spending money or financing, that maybe that will open up a little bit over the next few months. That's exciting.
Yeah.
Great. Well, the last story is we had talked a little bit at the beginning of the second article, And this is again from the Wall Street Journal, but it kind of dovetails with what we were just saying here about how folks are feeling a little bit more open to financing. This is an article in the Wall Street Journal. It said America is primed for a home renovation resurgence, and it talked about one of the main charts that it was discussing is the value of home equity that has really just skyrocketed over the last 4 or 5 years, and it is currently at $35 trillion. And so what they're arguing is that folks are using their equity to do home renovations, to do a lot more financing and capital intensive projects than they ever have before. But maybe that's something that will unlock a little bit more of the market to where people will start engaging in more transactions. Like maybe people are renovating their home to eventually sell it. You've talked about, Josh, before that maybe that will encourage more of the fix and flip model, that if people are able to use cash out refis to get into that world because of the home equity value. Are you seeing any kind of momentum in that regard, or any hope for us in the next couple of months, 6 months or so?
We know it's there, right? Because we've seen, especially here, and I mean across the country, but you've seen home values increase over the last several years dramatically. So we know that the home equity is there for anyone that owned a house previous to 2020. You saw really great growth the last couple of years, and as borrowing rates come in, then you're going to be more likely to tap into that equity if you want to hold on to it and reinvest it, whether it's in your house or in something else. Then the cheaper it is to borrow against it, then the more attractive that becomes. So I think just generally, just like you were talking about sentiment, I think it's good when people are starting to feel better about things, and then they're willing to take on a little bit more risk. One being, taking out a second loan is essentially what that is against your house. You feel good about the value stabilizing, and you feel good about making, taking it on, making that investment, whether you want to repair it, to sell it, or just to live in it. Because as we've seen this, there's still low inventory. So it makes a lot of sense that if you like where you live and you've got a good rate, to tap into some equity in order to improve your home, rather than have to go find something different that's further away from where you want to do life. So I think proximity to people is so important. I talked to clients. I was talking to clients about this yesterday. You can go out and find a great new house in a master plan community that has amazing amenities. The issue is you're going to have to drive out to it. And we find like one of the key things to people just enjoying life is close proximity to where you do life and to where your community is. So with there being, especially in DFW, kind of a lower supply, there's also a lot of the primary areas are pretty well built out. We're going to see people that have built up this equity that don't want to move away from where they're living, that are going to see that as a great option. Say, well, I don't need the cash maybe necessarily. I also don't want to move. I like my location. There's things about my house that I want to change. Well, let's tap into this equity and go ahead and make those improvements, and stay right here and continue being where I want to be.
That's great. That's great. All very encouraging. I think the point is that seeing some of these markets unlock a little bit is all really great on the real estate, on the individual residential real estate side, on the multifamily side. So
they're moving. I think it is tight still. I mean, like we said, we still had that big run up in the last couple of days on the 10-year. So we'll see where that ultimately falls out. But I don't think we're going to have a lot of real, I don't know. I think people are going to be just kind of on edge until we get past the election.
Yeah,
and
for sure.
And we know who's going to be ultimately running the country the next 4 years, and also for the next 2 years in Congress, kind of what that is going to look like. So
Yeah.
we're optimistic. I think we're going to have a volatile end to the year, but I do believe that it is, from a real estate perspective, just like you're saying, rates are coming down. Do believe that and I think there is a big push to get government spending reined in some. I think I think deficit spending is the biggest driver of inflation. So if we can get that reined in, we can deregulate, focus on the supply. then I think we're going to be in really great shape. So that's the direction we hope that we move in.
That's great.
And that's what we're gonna, we're prepared to move. Regardless, like I said, regardless, you got to be prepared. But we think if those things start to happen, then 2025 could be and beyond could be really great, especially here in DFW.
And I think,
Love that.
our suspicion, or my suspicion, is that activity kind of breeds more activity. And so when you think about tapping into home equity and all this money that's just kind of there that hasn't been unlocked yet, I think it gives you another piece of ammo if you are gonna, it just gives you more options. So if your basis in your house is so low, and you know that if you do improve it a fair amount, that your value, if you were to sell it, is going to be substantially higher. So there will be, I suspect, a percentage of people who do improve their house, and in doing so, add another 50 or 100,000 in value to their house above what their cost is. And so there'll be some people who decide to take that and run. And so my suspicion is, even though things like people tapping their home equity isn't directly related to new housing transactions or existing transactions, that'll kind of start to filter through.
Yeah, cool. I'm already seeing that. I had a friend that spent a lot of money on his house renovating it for that very reason. So yeah. Well, guys, thanks so much for your expert analysis, your insights, as always, and for your network, just sourcing a lot of great information that people like me and others listening probably don't have access to. So I'm really grateful for y'all. We have 2 weeks until the election, but there's also some exciting developments within the ALX business as well that I'm excited to talk about in the coming weeks. And so stay tuned for that. And we will see you guys on the socials and the airwaves. We'll see you next time.
Thanks, Brandon.